Welcome to Module 6. Today, we are focusing on financial management. Specifically, we will be looking at how businesses navigate the complexities of the global market through exchange rate risks and hedging strategies. Think of this module as your guide to protecting value. It is essential because in a globalized economy, currency fluctuations and technological shifts can drastically impact a company's bottom line. We're going to cover how to use financial instruments to hedge against risk, the strategic role of foreign direct investment, and finally, how the digital economy is reshaping the financial landscape. Before we dive into the strategies, we need to define the concept of a hedge. A hedge is essentially an investment made with the specific intention of reducing the risk of adverse price movements in an asset. It acts much like an insurance policy for your investments. To execute a hedge, investors often use options. We need to distinguish between the two main types, a call option and a put option. A call option gives the buyer the right to buy an underlying asset at a predetermined price. Buyers typically purchase these when they expect the asset's price to increase. Conversely, a put option gives the buyer the right to sell the asset at a specific price. This is used when the buyer expects the price to decrease. So, how do we determine when to use these options? We look at the strike price. This is the trigger price or set price within the contract at which you can exercise your option. Let's look at a scenario to clarify. Imagine you believe a stock's price will go up. You might buy a call option with a strike price of $55. If the stock rises to $60, you can exercise your option to buy it at the lower strike price of $55 and immediately sell it at the market price of $60, securing a profit. On the other hand, if you believe the price will go down, you might buy a put option with a strike price of $45. If the market price drops to $40, you can still sell your asset for $45, avoiding a loss you would have otherwise incurred. Now, let's look at foreign direct investment, or FDI. This is the purchase of an interest in a company by an investor located in another country. The strategic role of FDI is significant and is viewed from two perspectives. That of the investing company, like Samsung investing in Silicon Valley, and that of the host country receiving the investment. It is a critical driver for global business expansion. Moving forward, we must address the role of technology in global finance. We are currently witnessing a massive shift toward the digital economy, which refers to economic activities based on digital technologies and the internet. This has given rise to fintech, or financial technology, which uses tech to provide financial products. We see this in everyday tools like mobile banking apps, digital wallets, and peer-to-peer lending platforms. A prime example of this evolution is the super app, such as WeChat in China. Unlike the Western model where we switch between distinct apps for different tasks, a super app functions as an operating system within itself. You can chat with friends, pay utility bills, and even apply for a loan without ever leaving the interface. The ultimate goal here is digital retention, creating an ecosystem so convenient that the user never needs to log off. Finally, we must apply critical thinking to this digital expansion. While the digital economy brings benefits, it also introduces significant downsides. We face issues of inequality, as the digital divide widens the gap between those with access to technology and those without. There are serious concerns regarding privacy and security, given the frequency of data breaches. Additionally, we must consider the environmental impact of high energy consumption and the potential for job displacement due to automation. To wrap up Module 6, remember that financial management is not just about balancing books. It is about managing risk and adapting to change. By understanding how to hedge with options, leveraging foreign direct investment, and navigating the complexities of the digital economy, you can better position your organization for stability and growth. However, keep in mind that with technological advancement comes new responsibilities regarding privacy and equity. Mastering these concepts ensures you are prepared for both the financial and ethical challenges of the modern market. Thanks for watching, and we'll see you in the next module.